Hello, warriors. And I call you warriors. And that's a good one, Ryan. Because who felt like they were the Egyptians chasing Moses and the Israelis out of captivity through the Red Sea, the Sea of Red that we had yesterday. And then the sea closed up over their head.
I was one.
Okay, so, but you know what? Here Ryan is, ready to do battle again. Who knows why I call people warriors to do this and understand now. And there are a few new names here I want to acknowledge and say hello to. Regulars, Stephen and Sinatra, Alexander. Hello, Rudy. Nice to meet you from Venice, California, or Venice, Italy. Ugo, hi, buddy. Alan Chu Smith. Okay, so I need a new pair. We are. Someone stayed on the Egyptian side. Okay, Rudy. Who had the courage to go long? Oh, okay, so here's what I say. If you came in short S&Ps or long dollar prior to the CPI, good guess. Hi, Luca. Good guess. Because it was very binary. I don't know about you guys, but that kind of reminds me of roulette. How about you? So, all right, we're going to talk markets now, but you know, I'm just not fast enough, okay? You look at what happened in S&Ps after the number. I mean, let's go to a 15-minute chart. That's way back there. All right, 30. But basically, this was done in about, I don't know, 2-3 minutes as part of it. I have a hard time chasing candles like this. If you do it, you're a pro. So let's talk about what's happening today, Ryan. Yesterday, you know, pound is acting so much better. EG looks heavy, but you know, even though the euro's given it back, so far I think we've held some retracement levels with cable looking better.
Yeah, I think this euro dollar parity is going to be important, maybe for a close today. See where we close today in euro. If we hold above parity, I think you know, we've had the main move, if you like, from yesterday. But if we hold under, I feel
it has to do it today. Today it has to do it.
I think,
or
just
can it do it tomorrow?
No, it could do, but I think because of the proximity of what happened yesterday, you know, it's always the immediate sessions after that become really important, because that's either where you get a follow through or you don't, rather than, you know, 2-3 days later.
Well, I can say this so far, S&Ps were 10-15 handles higher. Now they're 11 lower. You know, that's taking the euro off early morning highs. Yeah, if we get another day like yesterday, the dollar's going to new highs. Probably.
Yeah, that's what I mean. These sessions, usually people are, you know, sorting out still what happened yesterday, you know, making their choices, you know, positioning, that sort of thing, and then from there on we get to know what's going on. But I've just put a post up in the newsroom with some traders are betting on 5% Fed rates by the end of the year via euro dollar trades. You know, this is the washing machine on with those Fed expectations. You know, bonkers yesterday.
I think they ought to take a look at the potential double top in yen. And I don't know about your platform or where you trade or what you use, but this feed, the high last night, and I was looking at it when it was like 99. I figured, you know, we would push above it. I'd do something tomorrow. But it actually took out the prior high by 1 pip, less than 1 pip. Anyone else showing that we took out the high on their platform?
I'll have to check that. I've got 95.6 as the high.
Okay, and back here it was 99.1. So you think they picked off stops of people who had their stop right over the high?
No,
I mean, huh?
We didn't get over.
What are you guys talking about? as far
This
as what?
high, the high last night in the yen took
No,
out.
I had my stop at 145. Well, I guess it depends your platform. I didn't get stopped out.
Okay, because yeah, but it did take out this high by half a pip.
Yeah, I guess
So
it probably
someone that
depends on
put
what
their stop
platform.
at this high is gone.
Yeah, that would have been retail. Maybe someone in retail wouldn't have been the
Well,
main market.
sure.
Yeah.
Well, you know, I didn't think it was George Soros's stop. I think he knows a little bit, knows a little more than that, huh?
Yeah, he would have
Anyway,
had a 001.
it was retail. It was Dale Pinkert. Okay, I'm retail.
So it was your stop there, is what you're saying.
They got me, man. Yeah, right. Right the market, wrong the trade for the 1 millionth time. Anyway, looking at the yen, yesterday Shy Girl said that they were testing repo facilities. She's not a real conspiracy theorist type of analyst, and she's talking about intervention. So everyone betting on higher yields. If we get a top here, I think they're late. And let's talk about this thing, and then I'm going to shut up. So the bonds, I really think, did something right in the most bearish type of environment that it could. There's glaring divergence in the bonds. I have to hand it to Grega. I thought that we had bottomed here. It was another Friday. Where was that? This week, right here, putting in a higher low. And Grega was looking for a new low and a new high in yields. And we're there. And we're diverging pretty good. I mean, the week, we're still a little bit lower on the week, but on a CPI number like that, that's not a bad response in bonds. And I think DSI is 11. So they're the most hated market out there, even more so than euro and other currencies against the dollar. Um, I'd be careful about being a real big bull on higher yields here. Maybe it's going to be, I don't know what the catalyst is going to be. Could it be that they actually work on risk off and the S&Ps are going to crater? Or is it because the yield curve's inverting? I'm not sure, but if we do get a bond rally, I think it could be pretty big. And
Yeah.
at least to the top of the wedge, 120. And there's like a reversion to the mean. The old breakout is up here. And you have I know that's a big call, but I think it's possible. A pretty classic 1, 2, 3. So I wouldn't be, at the minimum, I wouldn't be short bonds here, guys. And I want to bring Kman in on yen and your
Good
thoughts,
morning,
buddy.
good morning, Dale.
Good morning,
everybody.
Kay. So, what were you thinking when it was up there near 145?
Well, to be fair with you, no, I can't say that. I can't say that. You told me not to say that anymore. So I was actually sleeping already when it traded up there. But
Okay.
what I can say about it is that
Oh, you're talking about, let me be honest with you?
Exactly. So to be fair,
all right, that's good.
I think it's another. So Bank of Japan checked rates overnight, and the Ministry of Finance commented. A lot of the guys commented there. The finance minister Suzuki was out with a kind of official statement later on as well, saying that they don't rule out intervention. So actually, BOJ did what they told us, what Kuroda told us that they would do was they did not like moves of 200 or 300 pips per day. That's too big. So they checked rates, sent the dollar yen 150 points lower, and Suzuki was talking about interventions. It's not a random.
Just jawboning worked so far.
Yeah, but it's jawboning. But we are really at the last stage now of warnings before interventions. The checking rates is really the last stage before actual interventions.
Okay.
and I don't think it's a random pick to come in at 145. It's really a big level, the prior top. So and it's holding again. Some people, some traders were looking to start to sell up there as well. So it's far from a random pick. So now the 145 is really a solid line in the sand, I'd say.
Hey, good morning, Kman. How's it going?
Good man, yourself.
Good. Hey, you know, one of the things, it was late in the day. You were already gone, because it was late in the afternoon for me. I know most of you guys there in the UK were already gone for the day. But I got asked by one of the other traders in the community, and Dale, I'm going to take the charts really quick. Good morning, by the way.
Good morning.
But I want to show you some of these setups. So if I'm going to take you over to ForexAnalytix, because this is late in the day when I do the analysis at the end of the day analysis for the markets. But if you take a look at you know, like here's the pound yen yesterday. This is actually the chart of the day from 2 days ago, but you can see we were reaching for the 168, then we reversed. But that's not the important one, even though we did get a false breakout. You can see above the resistance. But take a look at the at a lot of these pairs, like the euro yen, false breakout. You know, we mentioned that in the analysis. Kiwi yen, same thing, false breakout. You can see we talked about that, and it wasn't just like, and then you have the Canadian yen was actually the only bullish one. The Aussie yen was also, you know, setting up for a possible false breakout. So a false breakout may be setting up, and all of these were just kind of setting up yesterday. Whoops, I don't want to do that. All these were setting up yesterday, and they're all kind of falling through. And I got asked, you know, by one of our traders, JT. He was like, you know, are you expecting the dollar yen to fall, and you know but the dollar to actually, you know, rally against other pairs? And I'm like, yeah, just because all the other crosses were moving. But you know, and I was actually kind of hoping for some sort of verbal intervention, which, you know, ended up happening. But I guess the question is to you, can you see can we get a situation where, you know, the dollar continues to rally against everything? You know, you get the dollar yen, you know, pushing above 145, but you know, the euro is also, let's say, trading down towards 97 cents or maybe 96 cents. So you get the dollar moving against everything, where the Bank of Japan and the Ministry of Finance doesn't really care so much, because it's a dollar move, not so much a yen move.
Yes, I mean, yeah, and it's but even with interventions, we could be in that kind of scenario. Imagine that Bank of Japan and MOF decide to go sit on the top at 145. Let's call it 145. It could have the effect of where if yields continue to rise, especially in dollar land, if yields continue to rise, it could be a side effect of interventions, is that the market is not buying as many dollar yen anymore, but since they still need to buy dollars, they are going to buy dollars against other currencies. And as a matter of fact, if you look at, call them the weaker links, like for instance, Kiwi, Norway today, it's exactly what's happening there. They are weakening. And I think that may be a side effect of verbal or not interventions eventually. If the rest of the dollar really rise, if all the dollar pairs rise, let's put it that way, I don't think Bank of Japan will be able to stop the dollar yen rise. But the effect is, as you say, it can weigh on other currencies.
It really, I'm thinking it may. And just going back over to here, this is you know, who you guys at home should be paying attention to is the Ministry of Finance. Would that be correct, Kman?
Come again, sorry.
Everybody should be paying
Suzuki is the
headlines from the MOF.
Yeah, Suzuki is the finance minister, is the MOF's boss. So they will be directing any intervention that can come out of it. And then you have Kanda in there, you have Matsuno in there. Those are the guys with the with the hammer, let's say, passing the hammer to the Bank of Japan, which will then execute.
I love these comments like this. The Suzuki, when he says if Tokyo were to intervene, it'll be to do it so swiftly. Things like that. That'll scare the living daylights out of anybody who's short yen. Which it's going to be a big deal. Anyway, hey, I wanted to ask you guys. We are PPI day, and we have I'm gonna pull up the dollar index really quick, and I'm gonna reference a few things as we're looking at the dollar, because it's not really just it's not all dollars are created equal type of move. We're looking at the Kiwi is at new 2022 lows. Same with the Aussie dollars approaching it. I'm still looking at, and most of you all know this, I'm looking for an Aussie long down here around 64 cents on a complex inverted head and shoulder pattern on a weekly chart. So we still got some distance to travel with the Aussie dollar. But notice how these commodity currencies are really weak. You got the dollar Canadian that's nearing yesterday's highs. I mean, dollar Canadian is at risk of a breakout towards 133.50 now, which would be the long-term channel resistance. We have the potential of moves here where the commodity currencies just get wrecked, and but you got the euro that's still holding up fairly well. I mean, I know we talked about this yesterday, but it seems like the 99-cent level is the new parity level for the euro. But I mean, that doesn't mean that the euro can't get back down to 99 cents. I don't think. What's that?
Size matters.
Size
this is where
matters.
Size matters. Size of central bank matters. I mean, you look at the Kiwi, you say making new lows for 2022. The Aussie isn't. Why is that? Well, the Kiwi, we know the RBNZ has said they've potentially got 2 more hikes and then they're stopping. And on the flip side, you got the Fed, who everyone's thinking are going to hike 100 pips next week. Simple rate divergence. The RBA is still hiking. That's why they're not at 2022 lows as we talk. Same with the euro.
And
they're behind, but they're getting on the hike path now. So
right. Well, and so that's the point. That's the point we were talking about, Ryan, yesterday, Ryan, in our chat room. And this is the one thing that I want to just mention. If you guys are not involved in the ForexAnalytix chat room, and we're talking about these type of subjects all day long, whether you're in the general chat room, the Flowonomics room, which is more of the macro chat room, where all the bigger minds hang out. I'll say I don't hang out there, by the way. But we got the trades room. Like, I just took a loss in my euro dollar. I wanted to pull it off. I had a short euro overnight. I just took it off for 15 pips. I'm going to keep my winners, obviously, because it's kind of what I wanted to do. But we talk about our trades. We have news tabs where we talk about different news articles that are coming in, and anybody can upload stuff. So if you guys want a great community where we're all at and we're talking, make sure you're in the ForexAnalytix community. Now, one of the conversations we were having yesterday was regarding this exact topic. If you look at what everybody's viewing the Fed, we were talking about where the Fed might be if they go 75 by year end. It takes us up to 4.25, and that might not even be the terminal rate that the Fed is actually targeting. And then there was an article that they posted in the news and research room this morning. I think it was you, Ryan, about the Fed might have a terminal rate of 5%. Where the hell is the Bank of England? Where's the Bank of England? Where's the BOE? Where's the RBA, the RBNZ, the Bank of Canada? Where are they going to be? At the end of 2022. That's where you start looking at the dollar index and going, holy crap. The dollar index could literally be trading up at 113 without much of an issue, right? So
but they're all going to be following. Everyone's going to follow the same path.
You think they are, or can they, or will it? Now, this is going to be an interesting question, Dale, that you're going to have to talk to Danny Blanchfire, who was obviously, an MP at the Bank of England, get his opinion here when he comes on in about 10 minutes. But look, I'm not 100% convinced that other central banks are going to be able to follow in the footsteps of the Fed. Sorry, I'm not there. And I don't think the market is either. And I think that was proof yesterday, right? I mean, I hear what you're saying, but I don't know if I agree.
I think I've been saying it for a while now. I think all central banks, and particularly the Fed, are going to have to take rates higher than people expect, because this inflation isn't going away.
Right.
I mean, look at the US. Okay, the inflation numbers are actually still, lower off their highs. You've got a rail strike coming up on Friday potentially. 3 days of that, and your country shuts down almost. What does that do to prices? And if that lasts for 2 months,
I think it's
what are you going to have with inflation?
I'm listening to you guys, and higher rates and the case that's being made could be right. And you know what? I think that makes intervention even more likely, because I think it would cushion the problems that emerging markets are having. Everyone on Wall Street is now crying about the strong dollar and how it's affecting earnings. So if they put a deal together, these central banks, in fact, they have to if they're going to keep hiking, because it softens the blow.
Yeah.
And, they need to.
Yeah.
For the record, I think this 100 BPs is bollocks. I'll eat my hat if they hike 100 BPs.
Wouldn't that be crazy?
That would be bonkers.
Yeah,
that'd be panic, and they won't. And I think
it would be panic. Well, then we'd have the S&P like literally. And by the way, this is if you look at the price action in the S&P, I just want to say this is something that you guys should be paying attention to, is that we are really at our lows from yesterday. I mean, and most people that have listened to me for a long time know that I say, red candles are usually followed by more red candles, or big green candles are followed by, or big white, green, whatever you want to look at them. Bullish candles are followed by big bullish candles. So, yesterday was a real shock to the system when you have the S&P that was down like 4%. Sure, things are holding up pretty well, but man, I don't know. I don't think PPI is going to come in as hot as it was, as or as hot as people are anticipating. Different sets of inputs that are coming in on a producer level than's hitting the consumer level. But I mean, I'm no inflation expert, and I definitely can be wrong. So that's why I'm trying to reduce positioning ahead of this. But that setup is a pretty bearish setup, especially if we break this S&P here. So what are your thoughts going into this producer price number? And I want to ask, let's Stelios, we haven't heard from him yet.
Hey, you haven't asked me anything yet.
Yeah, what how do you feel about inflation?
Well, yesterday's print was obviously larger than expected, but still kind of on a downtrend, if you can call it that. We had sterling UK PPI today, and that was lower than expected by 2 percentage points. So we're seeing, and it's not the only country, we're seeing kind of a relief in PPI numbers. So I think that, contrary to what markets may expect, we may see PPI lower than the expectation, which is 8.8% year on year. But from yesterday's numbers, I think nothing has changed in my macro view. I still think rates they remain high, yields remain high, so the path of least resistance for risk assets is lower. And for those who are in the chat room, I did close out the second half of my silver long yesterday after the number. I had closed out half of it the day before. It was still a very nice trade, but I'm now flat on that and just waiting to re-enter. We see what happens. But you know what? The Fed has one less reason to turn dovish, or to say, oh, yes, we're on the right path. We're going to take this the foot of the accelerator. They're going to do that, but I don't think they're going to do it just yet.
Yeah. All right. Well, they obviously, after yesterday's data, I mean, I don't think the PPI is going to change like the alter the path much here. But I think the market is definitely playing defense right now. I want to talk about, let's talk about a weaker piece of data. Let's say the data does come in weak. If you look around the spectrum of the dollar and you go, okay, well, every dollar is really quite strong against its counterpart, except the one that you can really prey on is the dollar yen. And most people know that I'm been playing the dollar yen on the short side, with a lot of people in our chat room actually now, and we got a nice lower high possible double top in the dollar yen. Let's say that we get a weaker producer prices number. We might be testing this 140, 150, and if that happens, we have this range expansion is basically 350 pips. So if we have a double top, then we're looking at a move that takes us down to 138. So just keep that in the back of your mind in case this print comes in. We get a relief rally because it's such a weak print. Could be. I'm not saying, look, it was in the UK, so could happen. And if that's the case, then we might be gunning for the 140 level, because if you factor in some weaker US data, MOF and BOJ that's starting to really tick higher on rhetoric, well, next thing you know, you got a dollar yen that could trade significantly lower. So I think that's something that we should all be keeping an eye on over the course of the next 20-30 minutes and going into the next 24 hours. So real quick, Dale, what are you looking at today ahead of the data? Anything that's like hot on your radar? I mean, I know you've been focused a lot on precious metals recently.
You asking me, Blake?
Yeah.
Oh, yeah. I mean, silver has morphed into the strongest looking chart. Well,
it has, hasn't it?
The yen. Yeah. So, I was saying that even risk off, if it happens, I think only generates a retrace in silver. And I'm telling people to get their levels ready now so that they're not analyzing on the fly, but they're able to execute. Just
you can go back here to see XAG. It's my chart from oops, I have a bunch of charts that are coming up, but let's see. Oh, they're pulling up here. Let's see. From yesterday, September 13th. So, it'd be this chart right here. Oh no, that's not it. September 13th, but maybe a different chart. There we go. This is from yesterday. You can see that flag that's kind of setting up, right?
Right.
So it is, I mean, for silver to be set, and I know Stelios is going to want to.
I have my bid at 1925 for your guide.
Well,
there you go.
I mean, we got a nice little bull flag setting up. So,
the next rally could be $4. This was, I think, around 240, 250. So I'm looking for 1.618 for a C or 3 that will take it to 22.5.
So, I see this descending trend line here in silver. It's really capped the market since early May. You can see all the touches. Yeah, if we break that, I mean, then we have a nice target in silver, which is 2140. I mean, that's a decent move from where we're currently at. I mean, percentage wise, that's a 10% move. I mean, which is Stelios makes that stuff overnight, but for us peons,
I think it's the beginning of a new bull market in silver. The XAU gold silver ratio is telling me that, and so I think we could see. You want to know for Pinkert, $38 silver, and
all
then
right,
60. I know you don't like those long term.
I like that.
I mean, no, it's good. Hey, I'll take 60. So we'll Stelios. Okay, we have less than a minute. Kman, Ryan, anything that you guys see that's that we should be watching real quick?
No, just keep your eye out for the volatility after the CPI. The market's going to be looking at this one, and that PPI can often be more volatile than CPI.
Got it. Kman, any last minute thoughts?
No, just volatile. I think, as I was saying before, Noki, Kiwi looking weak.
Got it. Okay. Yeah, they are really very much so. Those commodity currencies not looking hot. All right. So here's the dollar index. Here's yields, just to keep an eye on yields. And I'm going to put up the S&P over here So you can kind of see the S&P. Here's data flash, which comes with ForexAnalytix, by the way. We'll be watching the numbers as they come out right here where it says TBA.
I see Dan. I see Dan is here, so I'm gonna promote him.
Okay, sounds good. Mr. Blanchflower will be in just a moment. So you guys make sure you stick around for that. I'm sure Dale's got a lot of good questions with everything that's happened in the UK over the last couple of weeks. All right, California.
Okay.
Canada manufacturing numbers.
8.7 year on year. It's a marginal. Core PPI is hot, yeah. Well, overall, I don't think it's anything market moving, unfortunately.
Yeah,
pretty much on the money. Pretty much on the money.
Yields aren't really moving. S&P's not really moving. The dollar index firming up just a little bit. You got to watch some of these commodity currencies because they are really, really weak. I mean, we could see that. This Kiwi, I think, is one of the scarier ones because we're in like no man's land territory. There looks like a big elevator shaft down in this pair. I mean, we got a lot of air below us. So just, keep an eye on these if these commodity currencies start weakening today. All right, gents, I'm gonna pass it over to you. I want to thank everybody. Ryan, Kman, you guys have a great day over there in the UK. Stelios,
cheers, guys.
You always have a sunny day in Athens, so whatever.
You know it.
And Coach,
and I'm counting on the two Stelioses to push back on Erdogan today.
Oh so yeah,
I
want to see Steve and Stelios
in their uniforms.
So go grab their rifles and go might go to war with Turkey. Joking, and let's not joke about that, I guess.
You too, Anthony Kanakis. I could tell you should be in that.
All right, yeah, we got another couple Greeks running around here. And Dale, thank you so much for being here every day. Everybody have a great one. Remember, ForexAnalytix prices are going up for the first time in 4 years. They're going up at the end of this month, right around the end of this month. We'll have more information on that, but the prices are going up substantially. So just letting everybody know, if you want to try out ForexAnalytix, it's only $1 for 10 days. I'm going to pass it over to you, Dale. Have a great interview with Mr. Blanchflower.
Thank you, guys. And Stel, why don't you try a Trojan horse? Roll it into Ankara, see what happens. So, Danny, welcome back. Welcome back, Danny. How are you?
I'm great.
All right. So, I saw on Twitter that you just did a keynote address in Finland. Who was the group that you were speaking to?
Well, it's a bunch of people interested in industrial relations and labor markets, and I've been talking about all this stuff, that I've been doing on consumer confidence and the fear of unemployment. It's pretty interesting in Europe, and the same thing here. Remember, around the world, consumer confidence has collapsed, right? And it's in a position where central banks are ignoring it. But it's the only variable that predicts recession. If you look in the US, we look almost exactly as we looked in May, June 2007, right? And it completely predicted recessions, completely consistent with the 2 negative quarters of GDP growth.
You did prior to this. Correct. I want to acknowledge it, that you came in with your happiness index and a lot of different measures.
Exactly.
That were saying we would be here 6 months ago.
That's what I said. Remember, I said that 6 months ago. So the data for the US says that. For the UK, the index says the same. Same in Europe. I mean, UK, the confidence index is the lowest it's been since 1974, lower than it was in 2007 and 8.
Well, the new prime minister lifted. How do you feel about trust?
No, because here's a little thing. So you and I
had to ask you. You've got
to listen to this. So they've announced a bank holiday, but of course that will lower GDP by 128 because people will work for a day. So by construction, immediately output falls. No, we won't go. But the point in a way, which is pretty interesting, I've actually just sat there and looked at it. Maybe we can share this screen down. Can I share this screen? Yeah,
it's at the bottom, Danny.
Yeah, if I just do a sharing of this screen, a little, see if I can find this little thing I'm looking at.
There you go.
So what I'm looking at here is US GDP growth. And so basically what happened, so the first thing is the central banks all want to say, you should ignore this thing. You should ignore consumer confidence. But I think it's actually self-fulfilling, right? If I mean, you think of you guys, you all think, if people think the share price is going to fall, it's going to fall. If people think that the economy is going to tank and unemployment is going to rise, it will. So here's the problem, in a sense, for the United States. These data predict very well that output's going to fall. So let me just go to this little chart, which I just set up. I just got it, and it's US GDP growth by quarter. So here's the problem. If you go to then these are recession dates in yellow called by the NBR. So the NBR dating groups, people say, oh, 2 successive negative quarters don't give you recession. True. Why is that? Well, look here. So they call a recession starting in Q1 2001. And the reason they do that, and the reason the 2 successive negative quarter things don't work, is the US is often weird, because what you see there is, look, you get a negative in Q1 2001, a positive in Q2, and a negative in Q3. So that's the first problem. Second problem, in 2007 and 8, same thing. So the NBR calls the start of the recession is December 2007, but the problem is that you get a negative quarter there, you get a positive and four negatives to follow it. So the simple 2 successive negative quarter rule, which applies to basically every other country in the world, doesn't apply in the US because there's this weird intervening negative. But let's just go further on. So you got 2 negative quarters in 2020 and 20, with 1 and 2 in 2020, which the NBR did call. And now you have 2 negative quarters here, precisely predicted by the consumer confidence data. So all these clowns on the FOMC want to say things like, it's not really in recession, and raising rates isn't going to have any effect at all, and all's going to be well. Well, I don't buy any of that. The answer is that the US was in recession on any measure starting at the beginning of 2022. Now, the only issue is, what's come. Presumably the NBR will call it as that. I mean, it's as simple as that. The consumer confidence data I talked to you about over the last year predicted this. That's where we are. Also, what seems to me to be going on is that the US conversation is not about the global phenomena. So I was in Europe and I was talking about Finland, and I was talking about Germany and France and the UK and China. China's got the slowest growth in 40 years. The Eurozone's clearly in recession. The UK is clearly in recession. What's going on? And I just saw Jason Furman a minute ago, and I just tweeted it. He says, my thoughts are that my worry is inflation is going to be 4%. That's for the birds. The worry is inflation is going to be minus 4%. That's not what's coming. But the reality is that monetary policy takes a while to have an effect. And my estimates are right now that inflation will be below 2% by June.
June of next year.
June of next year.
All right. So
I mean, all you need, I'll just say one thing and then we can get into it. All you need, so the last 2 months we've had a 0, we've had a 0.1, right? That's what we have. Every month we know we have 12 numbers, we drop 1 and gain 1. If you took the 0 and the 0.1 and just repeated those, but let's make it simple. If we got, and this probably is too high, if you just took the average monthly change that you had between 2012 and 2019, and remember, we're probably going to get lower than that, that gets you to 2% CPI in June. So my view is that historically, and I can show you another picture in a second, which we can go, actually on my famous picture, I'll perhaps go to my second one. Can I share my second one, Dale?
Sure. Good.
Let me stop that one and show my other great one.
So is Paul looking at the wrong things, Danny?
They're all looking at the wrong things. I mean, remember, so here's the thing I wanted to sort of get to people. Let me show you these couple of charts. Let me show you this chart. So this is historically what you're actually likely to see. So the first thing to say is remember, and I like to say it this way, remember that we have no historical data since 1945, because we've had, think about what happened at we had the First World War, followed by a pandemic, followed by a global financial crisis. Now what we had is a global financial crisis followed by a pandemic, followed by a war. Now, historically, everything since 1945 tells us nothing. What happened after the Great Crash? Well, actually, we got high unemployment and deflation. So the question is really what historical record is there of what's coming? I think we're in recession. If you go to the Bank of England, they're now forecasting pretty darn much what I'm saying. But Dale, this is the most astonishing series, the most astonishing graph ever given. The US can't do this. So this is published by the Bank of England. This is inflation CPI in the UK since the year 1210. It's from 1210 to 2022, right? There's 820 observations. Now, historically, can you rule this out? I mean, just show it. What do you see? Well, you see periods of really high inflation. Okay. But actually,
King Richard and the Round Table.
Richard, all the Round Table. We're going to get to the Black Death in a minute, mate. I'm going to get to the Black Death. I'm going to go to Mount Temura.
That's amazing. These are levels we haven't seen in
right. But if you look here, so if I just say to you, there's nothing happened since 1945 that tells you anything other than look at the consumer confidence data, and we'll get to a second about why the monetary policy guys don't know what they're doing. I used to be one. So what this shows you is that after periods of high inflation, what follows? Well, historically, what follows is deflation, right? That's what follows. Of the 820 years of data from the Bank of England since 1210, 340 have been deflation. There aren't examples that I can see at all where high inflation is followed by pretty high inflation, basically. I mean, we get down here.
Hyperinflation, except for Germany.
Hyperinflation is followed by hyperdeflation. But the inflation, so at the Black Death. So let's just go back to a pandemic. 2 examples. The Black Death had 3 years of hyperinflation, and then it went to deflation. The Mount Temura, which is the eruption of the great volcano, meant that European summer was basically a winter. So food prices rose like crazy. There was huge inflation. Next 2 years later, deflation. So I don't think you can rule that out. The MPC is actually now forecasting, we'll see what happens, but its latest forecast has a 55% probability in 2024, inflation is below 1, and a 20% probability it's negative. So this is on the table, and all these people are making it up, saying, oh, I'm worried inflation is going to be 4, based on what? Guessing. I mean, I just tweeted it. This is just guessing. So the right thing to think, and I'll just stop and you can come back to me, but the right thing to think is this. I used to sit on the MPC. Here's what I always used to think. My job is to impact inflation 18 months to 2 years out, right? So I have a set of policies and I make a decision last month and I say, right, I think this is going to generate inflation at 2 years out. So now a new piece of data comes in. Should I respond to it? And I don't understand all these policymakers want to respond to it. The answer is that, well, no, I shouldn't respond to it unless it changes my view from a month ago about what inflation is going to be in 2 years' time. And did I expect to see this? If I did, then I have no effect. But the probability is that whatever these numbers are, whatever the number you got yesterday, inflation is going to be below 2 years out. So what should a member of the FOMC do based upon the data yesterday? Well, unless it was a surprise to them, nothing. They should have worked it out last month. If they didn't get it last month, they were wrong then. But all the expectations, in my view, are that inflation, the problem is that inflation is going to be potentially negative in 18 months.
Yeah, I saw a video today that even rents are going down in Phoenix, like a double zero type recession. Which, Blake, I just thought if you're here, you might want to know that. But anyway, I want to ask.
I'm going to say okay, but I'm here, but I'm listening in. But
okay, the rents are going down. I know you're thinking about.
Well, I wrote a column in Politico this week on exactly that, and apparently the person I seem to have gotten to, who then wrote about it, was Elon Musk. I wrote a column in Politico. I mean, so I'll just say this, and then let's just get people to come in on this. Okay, let's just try what I give an example. 4 years of data, Dale, right? So let's take the index number. In year 0, prices are 100. In year 1, they go to 110. Okay, inflation's 10%.
Right.
In year 2, it remains at 110. Prices are 10% higher than they were in year 0, and inflation is 0. In year 3, prices go to 105. They're 5% higher than they were in year zero, and that's 4.5% deflation.
Okay.
That's basically the model we have, and
Yeah,
I don't think any of these central bankers
the inflation that happened before doesn't go away. It's
right,
just a
because you have higher
comparison.
prices, but
Right.
inflation is not price level. The central bank
Right.
doesn't target price levels. So what you
Right.
have are falling oil prices, and the market responded, in my view, completely wrongly, because essentially, so think of clothing. You've got these tumbling freight costs, tumbling BDIY, you've got rents falling and all of this. So the core numbers like clothing, the clothing price hasn't fallen yet. Well, why not? Because it takes a while for the falling oil price to feed through to falling clothes prices. Because the clothing was brought to the store by the high oil prices that operated 6 weeks ago, right? So I think the market response was ridiculous.
All right. Well, he's rationalizing his policy through your specialty, and that's what I really wanted to get to.
Yeah,
he's rational. The tight labor market wants to drive unemployment to 5%. And is it possible that he wants the Great Resignation people to come back to work? Because
he wants to create pain, and I've said endlessly, the job of the central banker is to not create pain. That's what his job is. And the problem is that I don't think the labor market's tight at all.
Okay, I want to hear why.
Yeah, so I have a whole series of papers which tells you that you shouldn't look at the unemployment rate. So let's just get all the listeners to think of this. I'm the probably world's expert on this. I spent my early life, I came to Dartmouth to write a thing called the Wage Curve book. And that was about wages being impacted by unemployment, right? So the reason we should care about unemployment ought to be that it ought to impact wages, right? As unemployment goes up, wage growth falls. As unemployment goes down, everything gets better wages, right? Okay, until 2008, that worked. Since 2008, wages and unemployment are uncorrelated. They're uncorrelated with each other. So that tells you this is a false measure. So you need to go to other things. You need to look at the labor force participation rate, and you need to look at the employment rate. Well, the employment rate is a percentage point down on what it was at the start of the pandemic, and 5 percentage points down on what it was in 2000, and no other countries like that. So the Great Resignation is about the fact that people have raised the value of their leisure time. There is a huge amount of labor market slack, and those people, like my daughter who looks after her kids, if the wage rate was to rise, people would come back to work. The teachers at 55 have left because their leisure time has risen and the jobs become stinky. Parents complain all the time. So this is not a tight labor market. This is just a labor market. In a tight labor market, you ought to see wages rising like crazy, and you're not. So there's lots of labor market slack. The Fed doesn't understand it. What they're going to do is they're going to create lots of joblessness, and joblessness is much worse than inflation. That's the evidence, and they're making a huge error. The latest data is that there's a piece of new work coming out which shows this. A 1 percentage point rise in jobless, we'll take unemployment, but we'll just for sake of argument. If you raise inflation by 1 percentage point and you raise, let's call it joblessness, or even the unemployment rate by 1 percentage point, that raises, the unemployment bit raises pain 10 times more than inflation does. So what they're doing is they're trying to create a recession. They're going to create deflation. They think there's going to be a soft landing, and they're talking complete nonsense. And the reason we should worry is these are the same goons who missed the Great Recession. So if you go to the 2008 September Fed meeting, a week before the failure of Lehman Brothers, and not a single person at the meeting says recession. And eventually Bernanke says, well, it's possible we might have a very weak downturn with perhaps a quarter of negative growth. So these are the same clowns who missed the Great Recession, same at the bank, same people, same economists, and they tell everybody that there's going to be a soft landing.
That's what made your reputation, is you were crying out the opposite at that time.
Crying out the opposite. But here Dale, I want to hear from other people, but think of this. So I'm taking this, I have this voice which sounds the opposite, but what you have from the Fed is they're all singing from the same song sheet. All of them, every one of them. They're all, we got to raise rates. The only issue is how is it 75 or 100? We got to raise rates. And why? How in this uncertain world where we have no data since 1945 are there not 12 views? Why is there one view? And the reason is that they're all perfectly happy to be wrong together.
Oh, that's classic.
Right?
Tough to be wrong alone.
Right. Well, there's four options,
okay.
right? You could be right together. You could be all wrong together. And be like me, in the end, was right when everybody else was wrong. But that's so dangerous because you can't afford to be wrong when everybody else is right. Right? So what they're all happy to be in the pack together and all be wrong. And obviously, I think there are things to be made in the markets. I think the market collapse on Friday was a complete error. The inflation, it's just that the oil price and the declining commodities that you've talked about, lumber, all the other things, and the cost of shipping, all of that takes a while to feed through to the other goods whose prices haven't started to fall yet, but it's going to. I mean, how does that? BDIY was at 5,600. It's at 1,200. The jury container index is down 50% since the start of the year. If freight isn't going, containers, ships aren't going, lumber prices are falling, commodity prices are falling, rents are falling. How is that going to generate higher inflation? Go back to my example.
Could a trucker strike have an impact?
Well, I think so.
And a rail strike. Do you notice a trend here, Danny? And you talk about unions and strikes.
I mean, I do. And what's happening is the idea that there's going to be a wage price spiral for the birds. But an example in the UK, barristers, lawyers, barristers in the UK, the ones who wear the wigs, right? They're on strike. It's not just the rail workers, the barristers are on strike. The hospice nurses are going to go. And why is that? It's not because they're demanding, enormous pay raises. What they're saying is, my real wage has just fallen by 5% a year for the last 2 years. I can't do this anymore. Yeah. And so obviously people interpret that to mean this is huge power of labor, but it's not. Workers have just said, enough. I can't do this. And of course, why have they quit? Workers have quit because wages are too low. That's why they quit. Right? They quit because wages are too low for the current situation. So we're in deep trouble, and unemployment is going to rise. The labor market is going to collapse. The US is already in recession. Consumer confidence has collapsed, and Powell is talking complete nonsense, I'm afraid, just as they did in 2008. So my words for everybody are: the US is in recession. The Fed. The only issue for the Fed is not is it going to raise by 75 or 100. It's when is it going to cut? Actually, we should have had a meeting today of the MPC, similar story, but they cancelled it till next week because of the death of the Queen, which is quite interesting. But I think the issue is literally, I will be back with you, I guarantee, because how are they going to deal with the bad data that comes? You've got to raise, the terminal rate is 5%. Well, what about these really bad data that the prints are coming? And the bad prints are coming. The other thing on inflation. When
do you think we'll start seeing them? First quarter 23?
Yeah, I think so. The
Would that be about 6, 7, 8, 9 months since they started this?
I would like to do something else while we're here. I like this. I want to go to bls.gov. Let's just do this a second. Let me just go there.
All right, plus QT, Danny, beginning in earnest this month? Do you think they're going to follow plus QT? Draining the balance sheet.
But they certainly shouldn't. I want to show you something. Let me just do this. I'll just do this. This will work. This is the non-seasonally adjusted, but it'll do. You get the drift. Okay, let me just do this. I'm just going to do something for everybody. So I'm at the CPI. I'm at the CPI. So let me come out of that, Dale.
Okay.
Let me get that out of the way, and I'll share the screen with you. So here's what I want people to think about, really. I'll share this screen if I can. Where are we? Here we go. So look at this. So this is the CPI. So you could get it in 3 ways, right? And the 3 ways are, obviously, you could take the index number. You can take the current one. This is seasonally unadjusted, but it'll do. And you can get, so here's the thing that actually the seasonally, this is the seasonally unadjusted number. So the first thing is that the 0.1 we got was actually driven by the seasonal adjustment, right? These are the so look at what's coming, Dale. So the way we know about inflation is that we know we have 12 numbers, right? We have 12 numbers. Here's the 12. And each month, what happens is you drop one, we drop to 0.2 and we got a 0. So inflation dropped by 0.1. So it dropped by 0.2, right? It went from 8.5 to 8.3 because we dropped to 0.2 and we got a 0, right? But look what's coming. Next month, let's assume you just got zeros, say. Well, next month, we're going to drop a 0.3. So even if we've got a 0, inflation is just going to go from 8.3 to 8. But then look what's coming.
Yeah.
We drop a 0.8, we drop a 0.5, we drop a point, and then we start to drop ginormous ones. So in the start of 2022, we're going to drop a 0.8, a 0.9, a 1.3, a 0.6, a 1.1, and 1.4. So let's suppose, just to make life simple, we get 0.2 every month. We've had 2 zeros. But what if we got 0.2 every month? Well, that month it drops 0.6, then it drops 0.3, then it drops 0.1, then it drops 0.6, then it drops 0.7, then it drops 1.2, then it drops 0.4, then it drops 0.9, and then it drops 1.2. So that's how you get to inflation below 2. And if you've got numbers like 0 or even a negative because of the falling oil price, then you get inflation at 1 and -1. So Jason Furman says it's going to be 4. How is it going to be? You really think we're going to get 0.8s and 0.9s because the oil prices rise? How the hell does he get that? That's ridiculous. You with what I'm trying to say?
Yeah.
Right.
So why do you think their intention is to wreck the economy? You really think they're completely naive about the impact?
I think I want to show you something else as well, Dale, that I did just for you. I think they have in their heads that unions are going to be really powerful, right? Because they have in their heads Volcker, right? So let me show you this. So think about, so are unions powerful? Can you see this chart? Let me try this one. I'll try this one on you. Here's another one. This is, let me just find this one for you. Where am I? I think it's this one. So this is US union membership, right? Can you see this? I'll make it bigger.
Yeah, got it.
So obviously what we've seen in the last 20 years is that unionization rate is now around 10%. And it's been in decline. But what happened under Volcker? Well, what happened under Volcker was unions got really powerful, right? Yeah. So from 1975, unionization numbers went from 17 million to 21 million. Okay, they subsequently declined, but around the world, from around the mid 70s, union power got really high, and they were able to negotiate COLA clauses.
Yeah, and then Reagan broke them.
Yeah, well, exactly. So you had all this crazy union power growth. Paris riots of 68, all around the world, unionization rates rose, and Thatcher and Reagan and Volcker came in to smash the unions. But where's this? Where they have it in their heads that that's the world we're in. Well, we historically that's not a world we're in. We've got globalization, unionization rates are in decline. Workers are worried about their jobs. They're worried about paying for their childcare and all of that. So I don't know. I think it's why are they doing this? They think this is all going to be a soft landing, but this is nothing more than guessing. This is just wishful guessing.
They're hearing echoes from the past that do not line up with what's
well said
today.
Mate. Well, but history does rhyme, but it may or may not repeat itself. It may not rhyme. Remember what has occurred since 1945 to today that's comparable to what's happened in the last decade. The only thing that's comparable I gave you is what happened between 1914 and 1929, right? So what happened after that? You got deflation. How do you get, with the numbers I showed you, how do you get, Furman said just now in a tweet, and I just, that's the most ridiculous thing I ever heard. How do you get from an inflation of 8 to 4? Because the numbers just drop out. Automatically they drop out. So if anything that imagine the commodity prices start to fall. The oil price thing drops through, that number gets from 100 to 110 to 105. That's deflation. For it to be 4% inflation, it has to go to 114. How's it going to get to 114? It means there has to be another shock. If another shock comes along, they're right. So I think, why are they doing this, Dale? They're intentionally trying to hurt people. Why? I don't know.
Yeah, I don't you would think there's some agenda, and
well, where's the dissenting voices? Dale. I mean, in the sense,
I don't know. Yeah.
But I mean, you guys talk about. I mean, I could certainly come up with a scenario. My scenario is plausible. I mean, here's another thing that's plausible. Look at Japan. Japan has had inflation. It's gone in and out of deflation and inflation. It's moved between, inflation of 0.5 and minus 0.5. So how can you say to Jason Furman, you think it's going to be 4%? How can you rule out that we come like Japan? Can you rule it out? No.
No.
Can you give me any examples historically where inflation goes to 4? No. But since 2014, Japan's never had an inflation rate per year that's positive, and it's had 3 years where it's negative. Can you rule that out? No. So there ought to be 10 scenarios. Blanchard may be wrong, but if they're all saying the same thing, the likelihood is they're all happy to be wrong together.
So it's going to be overkill. We haven't felt it yet, and whatever happens now, there's going to be a bust later.
Well,
they continue on this path.
But I agree with that. But don't you think my data, where I showed you the 2 negative quarters, why? How is everybody? I mean, Paul Krugman writes things saying there's not really a recession. You can ignore the 2 negative quarters. Well, go back to my chart. There are no examples. There are no examples actually. So I'll go back to my example I had a minute ago. There are no. So let me just take this. Can you see that chart? I'll come out of it again and show that chart again. I mean, there are no.
Someone's saying you can ignore Paul Krugman, Danny.
Well, that's probably right. That's perhaps the
How about
story
Larry Summers?
That's perhaps the story I'm telling you. But look back here. So this is my chart. All you need to look at is in yellow. So since 1991, right? So there we go. I've got since Q2 1991, there have been no cases where there are 2 negative quarters. Let's just say within one of each other. There is not a single case since 1991 where there's been 2 negative quarters that have not been a recession. Never. And my data forecast all of these. So you say there's not a recession, but in every single case since 1991 where this occurred, it's a recession, and you are going to say there isn't one? I mean, come on, guys.
Yeah. Okay. Well, Danny, you know what? I want to thank you for being here. You know what you do?
What?
You take the con out of confidence.
Well, there was always the word econometrics, and somebody used to say, "Who put the con in econometrics?"
Yeah, but you take the con. You take the con away.
But Dale, the way I think you and I like to talk to one another, I just say, well, I may be wrong, but my view at least is plausible. I've shown you the real data. Here it is. Japan looks just like this. Historically, I gave you the data. And where's the evidence consistent with, say, what Jason Furman? None. Guessing. There is none. Consistent with what Powell says, it's going to be a soft landing. Based on what evidence?
Yeah.
Nothing.
Look, Danny, we're all wrong once in a while, okay? But it's not being wrong all the time. There's a big difference. So,
there's money to be made, but there's money to be made because if you work out that these guys are clueless, then the outcome is something that you can short and bet on, right?
Yeah, the Bears love you today, Danny.
Of course.
So I know you're fishing, and don't let those bears get your catch. Those whoppers you pull out of the water.
The alligators. No, it's actually the dolphins and the sharks where I go.
All right.
So yeah, the dolphins and the sharks is the story for today. Bye, buddy.
All right, Danny, thanks for edifying all of us today.
Oh, good.
Appreciate it, man.
Yes, sir.
All right, Danny Blanchflower, everyone. Follow him at D_Blanchflower. And really very nice interview. We are in a recession, quote, Danny Blanchflower, if you want me to summarize it. And you could join the team in 12 minutes for the morning edge. Good luck in the markets today, everyone. And don't just count your pips, count your blessings. Adios.